What are the margin requirements for Volatility Index, VIX, options? If you are curious about the margin requirements for Volatility Index options, you are in for a treat. Understanding these requirements is essential for anyone looking to trade these unique financial instruments. Unlike standard stock or index options, VIX options are based on the expected volatility of the S&P 500 index. This difference leads to distinct margin rules that traders need to be aware of. First, let's talk about margin reductions. Many index options strategies can qualify for margin requirement reductions. However, VIX options do not enjoy this benefit. This means that when you trade VIX options, you must hold the full margin requirement without any reductions. This is due to the unique risk profile associated with these options. Next, let's look at the initial and maintenance margin levels. The margin requirements for VIX options are typically set by the clearing exchange, which is the Chicago Board Options Exchange, and by brokerage firms. These requirements often exceed the minimum margin for standard equity options because VIX options can be more volatile. Traders are required to deposit and maintain a margin that covers potential losses, which can be significant given the nature of volatility. For those with accounts approved for portfolio margining, VIX options come with specific considerations. Under the Chicago Board Options Exchange's portfolio margin rules, VIX options are subject to valuation range limits. This means that margin calculations take into account the entire portfolio's risk. However, even with portfolio margining, VIX options still requiring substantial margin due to their volatility exposure. Another key aspect is the cash-settled nature of VIX options. Since these options settle in cash rather than through the physical delivery of an asset, the margin requirements must cover the risk of cash losses at expiration. This can lead to fluctuations in margin requirements as VIX levels change. If your account equity falls below the required levels, you may face margin calls, and brokers might liquidate positions to meet those margin requirements. When comparing VIX options to other index options, standard broad-based index options usually have initial margin requirements around 20 to 30% of the underlying index value multiplied by the contract multiplier. In contrast, VIX options generally have higher margin requirements due to their volatility basis and cash settlement. They do not benefit from some margin reliefs that apply to other index options. In practical terms, traders using VIX options should be prepared for higher capital requirements and potentially larger margin calls. Since VIX options are often used for hedging volatility or speculative strategies, understanding these margin rules is essential. This knowledge helps avoid forced liquidations and influences strategy choices, allowing traders to manage risk effectively within their available capital. So, if you are considering trading volatility index options, keep these margin requirements in mind. They are typically higher and less flexible than those for standard stock or broad index options, making it vital to monitor your account equity closely.